We're going to look at Helix Energy Solutions, and this is an oil and gas equipment and services company. They reported their quarterly financials today, and the stock is up 22%. Their quarterly earnings were 4 cents per share, beating out the estimate of 2 cents per share, and that's why the stock is up so much. Seems like a lot of investors and analysts were thinking this company would be losing money at this point when they're actually making money. So this is a good sign. I don't know if this is going to continue, but the stock is doing well today. It's interesting because if the analysts predict a stock's going to lose 10 cents per share, for example, and they lose 5 cents per share, the stock may actually go up in price by losing money just because it beat the estimates. It's such a big deal if a company beats the estimates. So what I do in my videos is I run my discounted cash flow model to try to figure out the true stock price for a company. I also look at their financial ratios and compare them to similar companies. And I do this with you throughout the entire video, so it's like we're doing it together. So let's get started with the model. This company's market cap is $682.5 million. It's a pretty small company. I usually don't invest in companies under 1 billion market cap. Their stock price is $4.55. Of course, if you do invest in companies with small market caps, you have the chance of making a big return, but more likely than not, you're probably going to lose most or all your money. Let's look at the free cash flow. Free cash flow is a cash flow that's remaining after operating a business minus capital expenditures. And that's how you value a company or an asset, is you estimate the future free cash flows and then you discount that number back to today's value, which is what I'm doing in this video. Now I'm going to pull the net income, which is a profit and loss on the income statement. And you can see some negatives in the numbers, and this is what happens with smaller companies pretty often. Let's pull the revenue. The good thing about revenue is it can't be negative. Looks like their revenue has been growing each year, which is great to see. They had negative free cash flow in 2016 and 17, but positive in 2018 and 19. So that seems to be a good sign that the company is improving. Let's look at a capital structure so we can figure out what discount rate to apply to the future cash flows. They pay $11 million of interest on their debt. Let's go to the balance sheet to see how much debt they have. We'll go to liabilities section. And current debt of $99 million, that's debt due within 12 months. And long-term debt of $306 million, that's debt due after 12 months. Interest payments are tax deductible. So let's get their effective tax rate. So the income before tax is $65 million. And their income tax is $7.9 million. So the effective tax rate is 12%. Generally, oil and gas companies have fairly low tax rates because they have so many subsidies and write-offs. So their cost of debt is 2.4%. To get their cost of equity, we need the beta. The beta is how volatile the stock is relative to the market. And they have a really high beta, 3.67. So the stock moves 3.5 times the market. Let's go back to the balance sheet to get their current assets. We need this to calculate the current ratio later. And current assets are mainly cash, accounts receivables, and inventory. And that's $440 million. And we also need the current liabilities to calculate the current ratio. This is debts and payables that are due within 12 months. That's $285 million. Let's pull their equity. That's assets minus liabilities. That's the value of the company according to the balance sheet. That's $1.7 billion. Their EBIT is earnings before interest and taxes. On the income statement, that's called operating income. That's $68 million. Let's look at a capital structure. The cost of debt is 2.4%. The weight of debt is 19%. The cost of equity is 31%. The weight of equity is 81%. So the weighted average cost of capital is 25%. That's a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. Since they have such a high beta, that's why their WACC is so high. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $763 million. We divide that by 150 million shares. and we get an intrinsic stock price of $509. It's trading at $455, so it's trading at an 11% discount. So it's a buy according to the model. Let's see what Simply Wall Street values a company. They're a little higher at $595. So it seems to be a good value, but it definitely is a risky stock in a risky industry, especially with low oil prices. You see, the stock had been trading up to $11 to $12 a share at some points, and it's dropped quite a bit. It's come up a little bit, but it still seems to be sitting at a discount. It depends how you feel about this company. So let's look at their financial ratios. They have a good PE, 11.8. That's price to stock, $455 over earnings per share, 39 cents. And to get earnings per share, it's net income over shares outstanding. And remember, the 4-cent earnings per share was for the previous quarter. What we're looking at is the earnings per share for the year. They have a price-to-sales ratio of 0.9, and if a company has under 1 price-to-sales ratio, it's considered a great value. That's price to stock over sales per share. And to get sales per share, it's just revenue divided by shares outstanding. Price to book is really good, 0.4. That's price to stock, $455 over book value per share, $11.33. To get book value per share, it's equity over shares outstanding. This number indicates that if the company went bankrupt, liquidated its assets, paid off all its liabilities, each shareholder would receive $11.33, more than a 200% return on what it's currently trading at. Current ratio 1.5, so they can easily cover their current liabilities. That's good. A low ROE, that's net income, $58 million over equity, $1.7 billion. They don't have much net income, so that's why they have such a low ROE. Interest coverage ratio is 6.2. That's good. That's EBIT over interest expense, so they can cover their interest payments. Doesn't look like they'll be going into default anytime soon. And the best way to look at ratios is to compare them with similar companies. I've done videos on Halliburton and Secure Energy, which is a Canadian company. And this is Helix in the middle, and if Helix has a number in green, they're better than the average. If they're in red, they're worse than the average. So they have the best PE. They have the only decent PE. Halliburton has negative PE because it has negative earnings, and Secure Energy has just a really high, terrible PE. In terms of price to sales, they actually have the worst price to sales even though it's under 1, just because the other companies have such a low number. The price to book is good. It's in the middle at 0.4, and the current ratio is also good even though it's worse than the average. They're the only company providing any return to their equity holders. The other companies are negative and 0. And they have the lowest debt at 19%, which is good. Seems like a company with a good future if they get through the coronavirus pandemic unscathed. Thanks for watching the video. Leave a comment.